Namaskar. After going through the qualitative measures of credit control in the earlier video, we are now going to discuss about the quantitative measures adopted by Reserve Bank of India. Quantitative measures affect the total volume of credit, and we know that the qualitative method affect the type of credit or extended by the type of credit or the flow of credit extended by commercial banks. They affect the composition rather than the size of credit in the economy. The quantitative credit control measures include reserve ratios, open market operations, and the policy rates. So we will be discussing each and every method one by one. First is the open market operations. Open market operations refers to the deliberate and direct buying and selling of securities in the money market by the central bank. In narrow sense, open market operations refers to purchase and sale by central bank of the government securities in the money market. In India, open market operations are used by Reserve Bank of India more to give support to the government securities than to regulate the volume of money. The Reserve Bank of India can influence the reserves of commercial banks, that is the cash basis of commercial banks, by buying and selling the securities in open market. If it is clear from the picture, if the Reserve Bank of India buy government securities in the form government securities in the market from commercial banks, there is a transfer of cash from Reserve Bank of India to the commercial bank, and this increase the cash base of commercial banks, enabling them to expand credit and control the recession. Conversely, if Reserve Bank of India sells government securities to commercial bank, the commercial bank transfer cash to the Reserve Bank of India, and their cash basis is reduced, and thus inflation is controlled, thus adversely affecting the capacity of commercial banks to expand their credit. Now the policy rates. RBI time to time manipulate, time to time modify the various policy rates in order to inject liquidity, either to inject liquidity or to absorb liquidity from the market. First policy rate is the bank rate. The bank rate policy is the traditional method of credit control used by a central bank. The bank rate or a discount rate is the rate at which central bank is prepared to discount the first class bill of exchange. The rate of interest which the central bank charges from commercial bank for rediscounting the bill is called bank rate. This bank rate policy influences the cost and availability of credit to the commercial bank, also influences the interest rate and money supply in the economy, as well as the level of economic activity. The current bank rate is 4.65%. The change in the bank rate generally has the effect on the cost of credit available to the commercial banks from Reserve Bank. If the bank rate is increased, the cost of lending rate to the borrower increases, due to which the level of borrowings of bank is reduced. In effect, the increased bank rate result in contraction of bank credit. Therefore, where the central bank of a country increases the bank rate, all other rate of interest also increases. This policy of raising the bank rate is called the policy of dear money. And the objective of such policy is to make money scarce and costly so as to restrict its use and flow to the deserving purpose only. If there is fall in the bank rate, it makes credit cheaper, increases the volume of credit, encourages businessmen to borrow and invest in opportunities, and increases the level of economic activity, thereby increasing the price level. Now, next policy rate is repo rate. The term repo rate stands for repurchase agreement. Repo is a form of short-term collateral-backed borrowing instrument, and the interest rate charged for such borrowings is termed as repo rate. In India, repo rate is the rate at which Reserve Bank of India lends money to commercial banks in India if they face a scarcity of fund. The current repo rate as on 22nd May 2020 is 4%, down from 4.4% due to in order to inject liquidity during the scenario of COVID-19. Commercial banks sell government securities and bonds to the Reserve Bank of India with an agreement to repurchase these securities and bonds from Reserve Bank of India on future date at predetermined price including interest charges. Now we continue with this topic. When RBI reduces the repo rate, the bank get money at a cheaper rate, and when RBI increases the rate, borrowing from the RBI become more expensive. This create an impact on final consumers of credit, which could be the institutions, businesses, or individual borrower. In the event of inflation, central bank increases repo rate as this act as disincentive for banks to borrow from the central bank. This ultimately reduces the money supply in the economy and thus help in arresting inflation. Now we'll come to the reverse repo. Reverse repo, as the name suggests, is opposite contract to the repo rate. Reverse repo rate is the rate at which Reserve Bank of India borrows fund from commercial banks in the country. In other words, it is the rate at which commercial bank in India park their excessive money with Reserve Bank of India, usually for short term. The current reverse repo rate is 3.5%. The reverse repo rate is opposite of repo rate here. RBI sell government bond to banks with a promise to buy back the bond from the bank in future. When bank have excessive fund with them, reverse repo allow bank to deposit these fund with RBI and earn interest on them at the same time. The whole process or whole functioning of repo and reverse repo is clear from this diagram, that in order to inject liquidity, RBI buy government securities from bank and provide liquidity to the banks in order to provide credit facility to the individual, to the businessman, or to the other borrowers. And when banks generate significant liquidity out of the business activities, commercial banks park their excessive fund to the Reserve Bank of India, thereby buying the government securities from RBI, and this leads to the absorption of liquidity from the economy. Next policy rate is marginal standing facility. Marginal standing facility is a window for banks to borrow from Reserve Bank of India in an emergency situation when the interbank liquidity dries up completely. The marginal standing facility is a scheme launched by Reserve Bank of India while reforming the monetary policy in 2011-2012. There are certain facts about the marginal standing facility. Let us go through all these facts. Bank borrow from Reserve Bank of India by pledging the government securities at the rate higher than the repo rate under liquidity adjustment facility. The marginal standing facility rate is pegged 100 base point or a percentage point above the repo rate. Under MSF, banks can borrow fund up to 1% of their net demand and time liability portion. The minimum amount for which RBI receive application is rupees 1 crore and afterwards in multiples of 1 crore. The current marginal standing facility is 4.65%. Now the reserve ratios, third category of quantitative credit control measures. Under reserve ratios, first classification is cash reserve ratio. CRR or cash reserve ratio is a requirement set by Reserve Bank of India for domestic banks to determine the minimum amount of cash reserve they need to keep to meet payment obligations. Under CRR, a certain percentage of total bank deposit has to be kept in a current account with the central bank, which means bank do not have access to that money for any purpose other than defined. The current CRR rate is 3%. Bank can't lend the money to corporate or individual borrowers or use it for the investment purpose. Bank also don't earn anything on money held in that account. It means that bank earn no interest on the money which is kept in the form of CRR with RBI. Let us go through an example of CRR. Suppose the amount of net time and demand liability is 10,000 crores. The rate of CRR is assumed to be 4%. In that case, the amount of CRR will be the 4% of 10,000. That is, the average cash balance to be maintained is equal to 400 crores. Now, what is the impact of change in the CRR in the economy? If CRR is reduced, the cash balance maintained with the Reserve Bank of India would decline and liquidity with bank increases. Corresponding amount is increases the lending capacity of banks. The increased lending increases the interest income and leads to more profit. Now next reserve ratio is statutory liquidity ratio. Statutory liquidity ratio or the SLR determines the amount of money a bank needs to invest in certain specific securities which are predominantly securities issued by Government of India and state government. RBI fixes this limit. The SLR to be maintained by bank is determined by the RBI in order to control the expansion. The maximum limit of SLR is 40% and minimum limit of SLR is 0 in India. Reserve Bank of India always determine the percentage of SLR. SLR or statutory liquidity ratio determine the amount of money a bank need to invest in specific securities which are predominantly securities issued by central government, as we have already discussed this meaning of SLR. We must know that unlike CRR, money invested under SLR window earn some interest for the banks. But in case of no interest is received on the amount which is capped as CRR with the RBI, but over the SLR account, on the SLR account, some interest amount is received by the banks, but they can't access this fund for lending purpose. Suppose someone has deposited, say, rupees 800 crores in the bank, then the bank receive 800 crores and has to put some percentage of it with RBI as SLR. If the prevailing SLR is 25%, then they will have to invest rupees 200 in government securities or in the form of cash, has to be maintained in the form of cash or the gold. Or on these securities, bank may also earn some interest, which is then given to the bank itself, but cannot be utilized for the lending purpose. Bank has to keep this interest amount in order to maintain liquidity for the banking purpose. Hope you have all understand the basic quantitative measures adopted by the Central Bank of India. We will be discussing more topics in the next videos. Thank you very much.